We'll be going over IRS Form 7206, Self-Employed Health Insurance Deduction. This is a one-page tax form, and it's fairly straightforward, even though it looks fairly intimidating, I guess, for a lot of taxpayers. So as a general rule, self-employed taxpayers can deduct health insurance costs on Schedule 1 of their income tax return, usually on line 17. So the Form 1040 instructions contain a worksheet where you can use the worksheet to enter certain information from your tax return, and then it will calculate the amount of your health insurance deduction. We'll put a link to a video that we've put together specifically about that worksheet, as well as some other resources in the show notes if you're interested. However, you may have to file IRS Form 7206 if any of the following conditions apply. If you are using more than one health plan in business, so if you have, let's say you operate a farm, and then you also have a side business, so technically you have two businesses, then you would need to make sure that you use a separate Form 7206 to calculate each plan's net earnings limit. So you would include the premiums you paid under each plan on line 1 or 2 of each form, and then the net profits or wages, and then you would calculate each form separately. So so that's one situation. If you excluded foreign earned income on IRS Form 2555, or if you're also including qualified long-term care insurance costs premiums in your health insurance deduction, then you need to file IRS Form 7206. So we'll take a step to talk a little bit about long-term care insurance. First, it has to be a qualified long-term care insurance contract. So the contract has to meet the following criteria. The long-term care insurance contract must be guaranteed renewable. It must provide that refunds and dividends under the contract can only be used to reduce future premiums or increase future benefits, unless the refunds are on the death of the insured or a complete surrender or cancellation of the contract. It must not provide for a cash surrender value or other money that can be paid, assigned, pledged, or borrowed, and it generally can't pay or reimburse expenses that would normally be reimbursed under Medicare, except for where Medicare is a secondary payer or the contract makes per diem or other periodic payments without respect to expenses. So in other words, you can't use like a long-term care insurance feature of an existing permanent life insurance policy. Those carve-outs specifically mean that you need to have a long-term care insurance contract that meets those conditions. And then the long-term care insurance services must be qualified according to the tax code, which basically means that it's necessary, either diagnostic, preventative, therapeutic, curing, treating, or rehabilitative service of some sort, or a maintenance and personal care service for someone who is chronically ill and is defined as such by a licensed healthcare practitioner. So a chronically ill person would be someone that for at least 90 days cannot perform 2 of the basic activities of daily living as defined by the federal government, which would be eating on their own, using the restroom on their own, maintaining continence, bathing, dressing on their own, or transferring. So getting up from a seated position, getting up from their bed to be able to move around, things of that nature. Or if it's an individual that requires constant or substantial supervision due to cognitive decline or other health and safety threats. So that caveat, if you're paying long-term care insurance premiums, that forces you to file IRS Form 7206, again, only if you're self-employed. So we're going to go over this tax form fairly briefly. It should not take that long because it's pretty straightforward. All right, so it's only one page, and then we'll use the net result to then put it into Schedule 1, line 17. In other words, it's still going to end up in the same spot that it would have been if you had been able to use the Form 1040 worksheet, which is a little bit simpler. So in line 1, we're going to enter John Doe's information. This is the total amount that he paid in the tax year for health insurance coverage. It can, as long as it's under your business or the S corporation in which you were more than a 2% shareholder. So this can include costs for you, your spouse, and your dependents. However, you can't include any costs where you were eligible to participate in an employer-sponsored plan, either by your employer or your spouse's, or a dependent's employer, or your child who was under the age of 27 by the end of the tax year. You can't include any amounts paid from retirement plan distributions that were considered to be non-taxable because you're a retired public safety officer. And then you can also not include qualified long-term care insurance premiums simply because we're going to move to line 2 and we're going to discuss that. So in this situation, John Doe paid $5,000 over the course of the year for him and his family. And so in line 2, you'll determine the smaller of either actual long-term care premiums or a specific dollar amount based on age as prescribed by the Internal Revenue Service. So John Doe, for the sake of this exercise, will say he's age 50 and he has a long-term care insurance policy. And even though he's paid a lot more than $890 in premiums, that's all he can list here. So you can't include payments for any month where you're eligible to participate in an employer's long-term care plan. So, and if John and his wife who work in the business were also covered, then you would have to figure out the amount for each separately. So if Mary were also age 50 and paying premiums, then we would simply, as long as what they paid during the year was more than $890, we would just double this and call this $1,780. So in this case, it's just John Doe. We put the $890 in here, and then we're going to add those two, put that net result here. So this is the total actual cost paid, and now we have to do some limitation calculations based on his self-employment income and what was earned. So in step 4 and step 5, they look fairly similar. So step 4, you're going to enter the net profit and other earned income from the trade or the business. If you go to the bottom, you'll see what these asterisks mean. So there's an optional method that you can use to calculate net earnings from self-employment, either as a farmer or as a non-farmer. So if you use an optional method, then you would simply enter the amount that comes from your business. And again, each business, if you have multiple businesses, you would need to do this on a separate form for each business. But you're going to grab that from the line 4B part of Schedule SE. And then if there's any other earned income from that trade, this could include net earnings and gains from the sale, transfer, licensing of property. However, it doesn't include capital gains. So if you sold something that was considered an asset, and you would need to determine whether or not it was a capital gain, more likely than not. So you would not include capital gains in the earned income, but you would You would include any licensing fees, any transfer fees, things of that nature. So in this case, we put $30,000 for John Doe. Also, don't include any conservation reserve program payments. Those are exempt from self-employment tax. So in line 5, we're going to enter the net profits as reported from Schedule C, Schedule F, Schedule K1, plus any other income sources that are allocable to profitable businesses. Don't include any net losses on these schedules. We're only talking about gains. So this basically would mean, if we had multiple businesses, then you would put the amount from this business here. What we're going to create is a fraction. So the amount from this business here, and then let's just say that John had a farm, and that farm generated $50,000 of profits. So between the farm and this business, there's a total of $80,000. Then line 6, we're going to basically force this into a decimal or a fraction, and then we would calculate the rest of these allocations based on that. So that's what you would do if you had multiple businesses, and that's part of the reason why you would complete this form, one for each business, so that they all should add up to the total that you would just put on one form as if it were a business by itself. So kind of the cumulative effect is, if you would use that term. So in this case, we have one business. So this business represents 100% of his income. And now we're going to multiply the deductible part of self-employment tax by the line 6 amount. So I went ahead and calculated offline based on $30,000 of income. I estimated there's probably some sort of adjustment that I'm missing, but I just did bar napkin math and came up with $22.95 as the deductible part of self-employment tax. So this figure probably is wrong, but we're going to use this anyway. So we're going to subtract the line. So we multiply that part by the percentage on line 6. Again, that's 100%. So we're going to put that all in here. But again, the intention would be to make sure that we're only allocating the part for this business if there were multiple businesses. So we're going to subtract line 7 from line 4 because we're deducting that part. So we can't, we have to continuously strip out the other deductions that we're claiming. So we deducted the part of the self-employment tax. Now we're going to deduct any retirement plan contributions. So let's just imagine that John Doe contributed $12,000 to his solo 401k. We're going to subtract that amount, and we've got $15,705. Now, John is not an S corporation. Otherwise, he would have gone from line 4. He would have skipped all of this and gone directly to line 7. So we'll back up and pretend to do that in a moment. But for now, we're going to skip line 11, and then we're going to enter the foreign earned income exclusion, which would have been from line 45 of IRS form 2555. So it's either attributable to the line 4 amount, this here, or the wages. It doesn't matter. We're going to put that $1,000 here, and then we're going to subtract that $1,000 from either the line 10 amount or the line 11 amount. So we get $14,705, but that's actually more than the costs that we actually paid, which is the $58.90, and that ends up being the self-employed health insurance deduction. So you take the smaller of line 3 or line 13, we'll put that on line 17 of your Schedule 1. And again, if you do this, you don't have to fill out that worksheet in the form instructions. Now, if you're deducting this on Schedule 1, you can't then turn around and include it as an itemized deduction on Schedule A. That's considered double dipping, and the IRS won't let you do that. So one or the other. And to be honest, Schedule 1 is much more preferable than any deductions that you could take on Schedule A. So you should take this every time. So let's go back and pretend that we were an S corporation for a few minutes. So let's go ahead and skip to line 11. Let's just say that John Doe pulled out $30,000 worth of wages instead. So he's going to pull out the $35,000, and then now he's going to subtract the $1,000 from the $29,000 of wages. We compare that number to the line 3 number, and we still come out with $58.90. So, generally you can't claim a deduction for more than what you spent, specifically on health insurance in this case. So the other limitation just means that you can't use that deduction to generate a loss. So if, let's just say that John Doe only made $5,000 and this results in $4,000 of income, he can't generate a tax refund by claiming above and beyond that. So the most that he would be able to claim as a tax deduction would be $4,000. So that's the entire intent of this. And that's basically all we have for this tax form. So we'll put links in the show notes to all the articles and videos that were referenced, so all the different schedules and the tax forms. We'll also put a link in the show notes for the video on how to walk through the I guess relatively simpler worksheet in the form instructions if you think that you might qualify, and we'll put a link to that video in the show notes. So for any articles, you can always go to our website, teachmepersonalfinance.com, type in the name of the tax form that you're looking for. In this case, it would be IRS Form 7206. You should see an article appear. So if you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. If you have any questions, comments, or if there is a question or a topic that you would like to see discussed in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.